What's up guys, welcome back to the Daily Stock Picks, and in this video we'll be going over the top 3 stocks that you should consider buying right now in September 2020. These stocks belong to the cybersecurity companies according to this article by Investors Place. So what I'll be doing for you guys is I'll be reading over this article with my beautiful voice, commenting, and we'll be conducting my own quantitative analysis to see whether these cybersecurity stocks either belong in our dividend portfolio or our value portfolio by using this checklist. More on that later, and make sure that you do stay tuned, right? And if you guys feel like being awesome, I would really appreciate it if you guys can give an early thumbs up to this video, as it will help the channel grow and reach a much targeted audience. So now, without further ado, let's get this video started. So 3 cybersecurity stocks guarding your health data. Companies are working hard to secure the safety of health data by stephan, jikh, Investor Place contributor. Digital transformation is sweeping across the globe, especially in the days of the novel CBPD, and in turn driving investors to find cybersecurity stocks to buy. Advances in connectivity as well as the widespread use of information technology is fast transforming the world. Although most of us may welcome such increased digitalization in our personal or professional lives, it also introduces a number of cybersecurity risks. In fact, many people, organizations, and governments are especially concerned about the safety of the health data, as businesses and individuals need to keep digital data and their cyber environment safe. Numerous upstarts and many established security firms have gained prominence. These cybersecurity companies have been constantly keep abreast of the developments in the field. For example, the cloud environment, including data storage, remote access to computer processes via the internet, as well as apps on personal devices, is altering workplace dynamics and how consumers interact with the business. Recent research led by Harjinder Singh Lally by University of Warwick in England highlight the increased number of targets, cyber attacks, and cybercrime campaigns since the start of the CBPD pandemic. These scams target members of the public generally, as well as the millions of individuals working from home. Cyber attacks have also targeted critical infrastructure such as healthcare services. Competition among cybersecurity firms that are protecting healthcare data is also heating up. They may work with hospitals and health systems to manage healthcare evolving cybersecurity risks, compliance requirements, and ensure patient safety. Therefore, today we'll discuss 3 cybersecurity stocks to buy. Cybersecurity stocks to buy. The first company in this list is CyberArk Software, ticker symbol CYBR. CyberArk specializes in privileged access management, that is, systems that manage user accounts with elevated permission to access critical resources in an enterprise. Put another way, it makes sure that right people such as corporate employees have access to the right systems and services. CyberArk stops the use of compromised or stolen credentials from accessing importing systems within an organization. Its customer base includes over half of the Fortune 500 list. These businesses typically choose CyberArk to protect their highest value information assets, infrastructure, and application. In healthcare, several notable clients include AstraZeneca, Boston Children's Hospital, and Pfizer. Earlier in the year, the group purchased Adaptive for $70 million with an aim to bolster its position in identity management space. On August 4th, the cybersecurity firm released second quarter financial reports. The total revenue was $106.5 million compared to the $102 million in the second quarter of 2019. The company divides revenues into 2 segments: license revenue, which accounts to $47.9 million compared to the $52.2 million a year ago. Maintenance and professional services revenue, $58.6 million compared to the $48 million a year ago. GAAP net loss was $4.3 million or 11 cents per basis and diluted shares. As of June 30, CyberArk had $1.1 billion in cash and cash equivalents. A year ago, the figure was $537.9 million. The management is focused on increasing the mix of subscription revenue, which provides revenue and cash flows visibility. The company expects revenues of $107 million to $115 million for the third quarter. Overall, the quarter was solid, but guidance was mixed. CEO Udi Mokade said, "We were pleased to deliver results ahead of all guided metrics for the second quarter. The integration of our adaptive acquisitions is progressing well. Cybersecurity market fundamentals remain strong. Identity security is at the top of customers' priority list, and our pipeline growth is robust. We are confident that we are positioned to accelerate growth as the overall business environment stabilizes." So pretty bullish, and the CEO is pretty confident on what the direction that the company is going to be heading for. CyberArk went public on Nasdaq Composite in 2013 at an opening price of $25 per share. Now it's hovering at $112. Year to date, Cyber stock is down about 4%. However, that metric tells us only half the story for 2020. Since the lows hit in March, the shares have gone up more than 30%. Its forward price to earnings ratio and price to sales ratio stand at 62 times and 99.6 times respectively. Long-term investors may consider buying the SIPs, especially if the price declines to $100 or below. Okay, CyberArk, CYBR. Its price to earnings ratio is 117.22, which is definitely on the expensive side when compared to the broader S&P 500 index, which is around 29.46. Now, in order for a company to meet my dividend portfolio, it basically needs to meet 4 rules. These rules or principles are based upon these 3 books. Make sure that you check it out. It's a highly recommended read. The first rule is that the current free cash flows must be positive. So if you want to be making sure that we're investing in companies that are actually bringing in cash rather than showing the cash rather than numbers in the income statement, right? And rule number 2 is that we need to be making sure that the dividends that are retained by the company only account to less than 75% or less when compared to the free cash flows. Meaning that, or in other ways of looking at this, is that we need to be making sure that the company has at least 25% of its free cash flows after paying out its dividends, so that the management or the board of directors can invest in the growth of the business or either pay off its long-term debt from its balance sheet. And rule number 3 is that it needs to have a consistent dividend growth history of at least 5 years or more. If you want to be on the conservative side, you can look at companies that have increasing its dividends over the past 10 years. And rule number 4 is our buy criteria. You want to be buying the stock only when the current dividend yield is greater than or equal to the 5-year dividend yield average, to make sure that we're buying the company at the right price. Now, I like to use Y charts because they do a really good representation of this financial information. If you were to look at this, we can see that the revenues have been increasing along its free cash flows. As the company does not pay out any dividends, it cannot be a part of our dividend portfolio. But let's see if the company can meet our value portfolio criteria. So in order for a company to meet my value portfolio, this time it needs to meet 5 rules, right? And these 5 rules are based on these 3 books. And my favorite is this book called The Little Book That Beats the Stock Market by Joel Greenblatt. Now, the rule number 1 is that the return on invested capital must be greater than or equal to 10%. So this basically shows how profitable the company is. For every $100 it invests into the company, if the ROIC is 10%, it means that 10% is being returned to its shareholders as profits. And rule number 2 is that it needs to have consistent cash flows. As we've discussed previously, we need to be buying into companies that have a good cash flows so that we can sleep well at night, knowing that the company and the company management are investing or making decisions in the best interest of the shareholders. And rule number 3 is that it needs to have a strong balance sheet. Generally, large companies take on long debt from other third parties like banks, investment services, and other capitalists investors who are willing to make investment in the company. we want to be making in order to grow its top line, or in order to grow the company at a larger or at a faster pace. So we want to be making sure that the company's long-term debt on its balance sheet, it should be able to clear it off within 6 years or less than 6 years. And rule number 4 and rule number 5 are our buy criteria. According to rule number 4, we want to be buying the company when it's at least at a 20% markdown from its fair price. We'll be calculating this within a few seconds. Make sure that you stay tuned and smash the like button if you guys haven't already. And if rule number 4 isn't met, we can consider buying the company if the price to earnings ratio is less than 50% of the price to earnings ratio over the past 5 years, of the highest price to earnings ratio, that is, and it is lesser than the S&P 500 index. So since it's more than the S&P 500 index, we know that rule number 5 is out of the gate from the beginning. But now let's look at the fundamentals of the company, CYBR. The return on invested capital is 8%, which is not that attractive, but we can let this one go if we can find out that the company has really good fundamentals. So looking at Arc Software, we can see that the company's free cash flows were around $9 million. Let's see how many times it has doubled. 9 double is 18, that's 1 double, 36, 36 double is 72, 72 double is 144. So around 4 doubles, so around 35 to 40% increase year over year in its free cash flows, which is completely bananas, and it's a really good positive sign to see. So the consistent cash flows is pretty good, and it has been increasing at a pretty good substantial amount. And the strong balance sheet, we can see that it currently has $493 million as its long-term debt, which it can easily clear off with its current assets within the coming 12 months if the management decides to do so. Now let's calculate the intrinsic value of the company. We can see that the earnings per share is $0.87. And looking at the price to earnings range at which cyber stock has been trading over the past 5 years, we can see that it's 44.90, 158.38, CYBR. So the analysts are estimating that the company can grow around 6.4% for the next 5 years. So what we'll be doing here is we're basically projecting the earnings per share 10 years from now by multiplying with the analyst estimates, and we want to be looking at a conservative price to earnings ratio. We can either consider the average price to earnings ratio of 101.64, or we can multiply this by 2. We'll get the conservative one in this case, which is 12.8. So we want to be implementing the minimum one, which is 12.80 as the price to earnings ratio. The fair price at which we should be buying, like 10 years from now, is that the company could be around $19.46 if you were to look at that. And the fair price that we should consider buying the stock is $5.53. And if you were to consider 80% markdown from here, we want to be 20% markdown. We want to be buying the stock when it's around $4.43. Looking at the current price to earnings ratio, we know that it's not going to be trading somewhere around that time frame at all. If you were to look at this, and if you were to consider maybe 44.90, the lowest of the price to earnings ratio, even if you were to consider that, the intrinsic value of the company wouldn't meet our requirements in this scenario. And it definitely seems to be overvalued at its current price to earnings valuation and its intrinsic value calculation. Now let's have a look at the second company in this list. ETFMG Prime Cybersecurity ETF hack. So since it's an ETF, we won't be able to use this checklist because it's only for individual companies, as we won't be able to get all the metrics that we require for meeting the checklist criteria. But I just want to read the article to see what the writer has to say about this ETF. The expense ratio is 0.6 or $60 per year on a $10,000 investment. The ETFMG Prime Cybersecurity ETF is a portfolio of companies providing cybersecurity solutions that include hardware, software, consulting, and services to defend against cybercrime. Hack, which tracks the Prime Cyber Defense Index, includes 57 holdings. The top 10 holdings constitute over 30% of Hack's assets under management, which stand around $1.5 billion. The top 5 companies are SailPoint Technologies, Cloudflare, Splunk, Cisco, and LiveRamp. Most analysts concur that the cybersecurity market is booming. Spending in the space increased significantly in 2019. Firms' cybersecurity investing could reach $250 by 2023. So far in the year, Hack is up 19%. It hit an all-time high on August 27th, and it's priced just over $50 per share. Long-term investors researching cybersecurity stocks to buy may want to Hack on their radar. A potential pullback towards the $45 level or below would mean a better entry point into this fund. Okay, interesting. ETF. So it's basically, rather than investing in a company, you'll be investing into a basket of companies, which is pretty advantageous if you were wanting to diversify your portfolio. Now, let's have a look at the third company, which is Palo Alto Networks, PANW. Santa Clara, California-based Palo Alto Networks is one of the largest cybersecurity firms worldwide, offering a range of products and services. Seasoned investors know of the company as a long-time maker of endpoint security. Now management is working to make it an all-in-one platform package for all security-related requirements. The products and services include firewall appliances, panorama, virtual system upgrades, subscription services, support and maintenance, and professional services. In late August, Palo Alto Networks reported the fiscal fourth quarter and financial year 2020 fiscal results. The fiscal fourth quarter revenue grew 18% to $950.4 million. Similarly, 2020 revenue grew 18% year over year to $3.4 billion. Adjusted earnings was $1.48 per share compared to the earnings of $1.47 per share a year ago. Overall, it was a strong quarterly report that beat on the top and bottom lines. It showed strong billings and an upside for financial quarter 1 revenue and fiscal quarter 1 revenue and earnings outlook. CEO Nikesh Arora said, "We had a strong finish to our fiscal year with fourth quarter billing accelerating to 32% year-over-year growth, driven by strong execution, work from home tailwinds, and continued success in the next-gen security. The global shift to work from home is helping Palo Alto Networks move its businesses towards a cloud-based deployment and billing model. Year to date, PANW stock is up more than 10% to $255 since the lows seen in early spring. The shares have more than doubled, therefore some profit taking is likely in the coming weeks. Long-term investors may want to do further diligence on cybersecurity stocks with a view to invest, especially if the price declines towards $245. Okay, now let's have a look at PANW. Price to earnings ratio. Okay, so it doesn't have any profit at the moment, so that's why it's coming up as NA. Now let's see if it meets our dividend portfolio criteria. Hopefully that's not the case. Okay, we can see that the revenue and the free cash flows has been increasing consistently. Since it doesn't pay out any dividends, we won't be considering that as a dividend portfolio. PANW. The return on invested capital is negative. As a result, I wouldn't consider looking at any point in time looking at this company because the return on invested capital is negative. We want to be looking for companies that are profitable. So I understand that not all of these companies have met our criteria, but please let me know. This is what my perspective is. If you guys think that these companies should be evaluated differently, make sure that you put down in the comments down below. Closing remarks. So on the date of the publication, tscan jikh did not hold either directly or indirectly any positions in the securities mentioned in this article. The author has worked in an investment management for over 2 decades in the United States and the UK. In addition to former higher education in the field. She has also completed all 3 levels of Chartered Market Technician examination. Her passion is for options trading based on technical analysis of fundamentally strong companies. She especially enjoys setting up weekly covered calls for income generation. She also publishes educational articles on long-term investing. So if you guys have stayed around till this part of the video, thank you guys for the hardcore fans. And full disclosure, this video is for your education and your entertainment purposes only. There is no guarantee that you'll earn any money using the techniques and the ideas mentioned in this video. This is not financial advice. Please consult your financial or tax professional prior to making an investment in these companies. So if you guys feel like being amazing, make sure that you smash the subscribe button and turn on the bell notification icon so that you can get notified as soon as we post new videos. Now, thanks for watching. See you in the next video. Peace.